Welcome back. You're watching HFO-TV. HFO-TV is co-sponsored by the construction, repair, and restoration firm J.R. Johnson, the real estate law firm Baljanik LLP, the tax deferral accommodator Butler Exchange Group, the mortgage banking firm Gantry Incorporated, and forensic building consultants providing building structural science services.
Welcome back to HFO TV. I'm Greg Frick, partner at HFO Investment Real Estate. And today we're lucky to have with us Blake Herring, principal at Gantry, Inc. Gantry is a lending institution. Maybe you can give a little highlight about what they do and what you do, and we'll then talk a little bit about the market, what you're seeing this year, what's changed, and kind of what your prediction is for the future. So thanks for taking the time to speak to our audience today.
Absolutely. Thank you for having me.
What's the background on Gantry for people that don't know? And we've known each other for 25 years doing business together, but this is kind of a new venture, a new company, but same line of business you've been into for years. So maybe tell the audience what it is and what you guys do.
Yeah, thank you. So Gantry is actually a new name to the market.
Right.
The company was formerly a company called Newmark Realty Capital,
Okay.
Headquartered out of San Francisco. They were formed in the early 90s by three guys who left Norris, Biggs, and Simpson, which was headquartered here in Portland
Right.
and had a presence up and down the West Coast. Gantry was formed out of the departure from the name Newmark, which conflicted with Newmark Knight Frank.
Okay.
So Gantry was formed just at the end of 2019. We joined Gantry, the principals and originators on the loan side. In fact, our whole loan department joined Gantry in March of 2020, right before COVID hit.
Okay.
So our transaction actually closed March 2nd,
Wow.
and we all went home March 17th. So that was our timeline.
So offices up and down the West Coast, national presence in the lending environment?
That's right. That's
Okay.
right. So we have offices, Seattle, Spokane, Portland, San Francisco, LA, Orange County, Phoenix, Las Vegas, and then we have an outlier out in Buffalo.
Okay.
But primarily, of course, just a West Coast-based company. There's 20 of us that own the company. I'm one of the principals. And we are the largest independently owned mortgage banking company in the country.
You are, okay.
And we originate, $4 to $5 billion a year in loans. And then we service now about $17 billion in loans.
Gotcha. So for you who've been in this market, like I said, we've known each other for years and have done multiple deals together. You know, it's a new name, but the business line is relatively the same in terms of the lending environment that you do.
Exactly. I'd say the largest property type that we finance is multifamily.
Okay.
And then we also do just all commercial property types. So office, industrial, retail, those are the main four. And then in addition to that, we'll occasionally do a hotel, we'll do self-storage, we'll do just about anything that's income producing,
Okay.
as long as it makes sense.
And is it life companies? Kind of what kind of loans are you guys known for? Kind of where's your sandbox?
Yeah, I mean, here in Portland, the bulk of what we do certainly is life company, and the bulk for the whole company is life company,
Okay.
probably 65 to 70%.
Got it.
But then we do a lot of agency business on the multifamily side.
Right.
And then we do a lot of bank and or credit union and or, debt fund business as well.
Okay. So now let's talk a little bit about the multifamily and this market. It's been kind of a strange year. We had COVID last year. Transactions kind of slowed down. Second quarter of 20 came roaring back. We haven't had from a value, cap rates of, if anything, we've had cap rate compression. I mean, what's the lending market? I mean, kind of what did you see the evolution from 20 to 21, and what do you expect coming in 22? Was it a surprise you, the volume, and kind of what was your outlook?
Yeah, so as we went into this, again in March of last year, there was a lot of concern about how bad is this going to get, right? I mean, we don't know what a global pandemic looks like or what the effect could be and how many people are going to be impacted. So there was really a pause there for even just a couple of months.
Yes.
Where people really didn't know what to do, and people hunkered down and kind of waited to see. As we made our way into the summer, I would say, transaction volume started to pick up a little bit. What we saw was an acceleration from our standpoint of a bifurcation in the market. So investors really gravitated towards apartments and industrial and started shying away from office and retail. And as we made our way
which put more capital into more allocation of those two asset classes, which again then pushing cap rates down.
For sure. So lenders started weighting their money towards those property types
Got it.
where there was comfort and there was clear performance. Whereas there was a real concern about how our office and retail going to perform as we come back out of this.
Okay.
We actually have seen stronger performance than we thought, particularly for suburban office and retail. Urban office still remains to be seen, and that's a trailing indicator or a lagging indicator, meaning we may not know for a couple of years how bad that market's been hit. So I'd say urban office still remains a strong concern. But most of the other property types, a lot of money's continue to flow to them, again, including retail.
So in retail, I mean, even pre-COVID, there was, changes and questions about retail. It seems like COVID's kind of, I don't want to say clarified, but it's kind of picked the winners and losers. But again, it also feels like this, some of the capital that maybe went to retail, it's still going there, but not maybe to the percentage. But again, it's so much more getting pushed to multifamily industrial. Yeah. Is that up and down the West Coast? Is that national?
Yeah, I mean, you're seeing some of the same trends that I am, that savings is way up as a result of what we've gone through, plus the money that has been pumped into the system has helped bolster people's savings accounts. You're probably aware that 70% of our overall economy is driven by consumer spending. So it's important that that stays strong, and luckily it has.
Right.
We are certainly seeing inflation now across the board, but I would say that investors or just consumers have stayed, active, certainly in the suburban markets.
Right.
Again, a little bit of concern in the urban for retail, but really active with your grocery-anchored centers. Lenders love those. And then just centers that have good demographics, well located, and ample parking.
Got it.
Those are the parameters that really factor in.
Is there, now the other thing we've seen is, on the multifamily is tertiary markets that maybe weren't, they were doing okay, but now we've got, larger amounts of capital. They're looking in outlying areas. I mean, is there a concern in 22 that may slow down? Do you see a flight back to the urban in terms of loan dollars? What's on the horizon, or you're watching what the lenders are saying? How long will this go? Or is this kind of a new shift that, people don't have to live in an urban center? Maybe some of these outlying areas with multifamily are attractive and you're seeing rent growth. I mean, what's your take, or what are you hearing on the street?
Yeah, so it's really similar to what happened actually after the Great Recession in 2008 and 2009, when money slowly started coming back to the markets after a major disruption. It goes to the major capital markets first, right?
Exactly.
So all the major consumer markets. And then it slowly filters to secondary markets, which Portland would probably be classified as a secondary. Now, as we're in the later stages of this last cycle, we're really seeing money flow into tertiary markets that would have been almost an impossible ask even 5 years ago.
Right.
And now both investor capital and debt is flowing much more readily, if not free-flowing, towards very small markets where the property performance warrants it.
Right. 2 years ago, we would never thought that this group or this lender would even look at this geographical area.
Exactly.
And now it's we're also now seeing capital coming back to the core in terms of multifamily, because we had in Portland specifically with inclusionary zoning, we had this run up of, deliveries that slowed down.
Yes.
We had concessions with COVID. We saw some, if there was any real pain, it seemed like it was core on lease ups. Some of the capital kind of went away. Now you're starting to see, hey, is there an opportunity back there? I mean, are you hearing the same thing?
Yes, for sure. And it's just been articulated that the number of cranes has now been cut in half, right? So the supply is limiting, and that brings a lot more comfort to the lenders, because it was a double whammy when you had both oversupply because of the factors you just outlined, and then you get hit with the COVID and everything else. The urban core was definitely a concern, but that's certainly coming back.
Right. Now, I know in 20, when we were in COVID, there was reserves and things like that, because nobody really knew, were tenants going to be able to pay, the relief, the federal relief in terms of rent dollars, it was unsure. Is there anything different? Are you thinking any from an underwriting standpoint for, as we go into 22, that owners should be aware of, that, is maybe on the horizon, or, are things kind of stabled out to where it was beforehand?
Yeah, so the concern and the biggest thing we're dealing with now is just because of the amount of capital that's flowing, particularly towards apartments, we're seeing such a compression in cap rates that from a debt standpoint, we're really struggling to get to even, say, 65%, where we used to be able to
because of the debt coverage ratio, because of the pricing.
Exactly.
Right, okay.
The pricing's gotten so tight that the net income from the property really doesn't support as much debt as historically it had to give lenders the cushion and the comfort that they need.
And do you think you'll see some lenders start shrinking down the debt coverage ratio to try to pump up the loan dollars? Or is there kind of a floor to where it's not going to go below that? It's just going to be the amount of leverage, or maybe there's secondary mezz financing for maybe that little piece, the equity stack.
Yeah, I mean, lenders are always trying to get their money out, right? So there's that driver, and then everyone's always trying to get yield. So yes, there will be lenders that are going to start pushing the envelope, thinning down that debt service, accepting a lower coverage in order to maybe get a little bit more yield. Now that applies to certain lenders in the market. There's others that do not have that risk profile. So, the market will probably sort itself out that way. But if this market trend continues, lenders generally like to underwrite on what they consider historically supportable cap rates. 5 years ago, that was not less than a 7 cap rate, right? In today's market, that's not less than 5. So we've seen a 200 basis point compression there. If this trend continues, maybe pretty soon we're talking about 4.5s or less.
And what do you see, or what are you hearing regarding, interest rates, which is always, as I always tell people, they always ask me what I think interest rates are going to go, and if I would have known that, we probably wouldn't be sitting here. But what are you thinking? The short term that we're going to see maybe a slight increase, or what are you telling your clients regarding interest rate risk in the future?
So probably the biggest thing that comes to mind on that is of course our interest rates are predicated on Treasury yields. The Fed has already said they're going to stop slowing down their purchasing program. So that's very apt to increase the yield on the Treasuries, which is going to increase rates. That's one factor. But the broader factor is really just how does the overall economy perform? And if there is another setback, if we have another Delta variant or something like that, that certainly could alter things and send our rates backwards. But generally the trend right now has been an upward progression on rates. So rates are trending back up.
And what we've seen, even when we've had the slight bump in the 10-year, we haven't seen, maybe a little bit in cap rates, but, like I said, with so much capital coming out of these other from retail to office now getting into multifamily, it's just continued to keep the cap rates, even with the slight increase in the 10-year. So
that's the biggest trend in this last cycle. Again, the cycle being from 2009 through 2021, basically, until now. It has been the infusion of capital across the board into our industry in general. As we talked about, I mean, it is, commercial real estate is considered a viable investment asset class right along with stocks and bonds.
Yeah, and I'll say to people, I think the biggest underestimation that coming out of, 8 and 9 was the amount of capital that was now willing to go into, what was considered back when we started in the business, alternative investments. This is not considered an alternative anymore. And what that has done to the yield profile and the yield expectation has been, again, not only say mind-boggling, but just shocking the amount that has now transferred over. So
and we're now seeing investors who are really comparing their investment in just a savings account to what they can get in real estate, and really do they totally understand the risk of the lack of liquidity and the volatility that can occur. Remains to be seen, but there's a lot of new investors out there.
I totally agree with you on that one. Well, thank you for taking the time to speak with us today. I'm sure we'll do this again, and we'll see you next time on HFO-TV.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information.